annuities. So the thing, oh, so who's jumping in here? Jay's jumping in here. Okay, that's what. All right. So Jade is here with us. So, all right, so we're gonna go ahead and start chapter two. Chapter two is gonna be based off of or finish up chapter two. This is gonna be annuities. We're gonna cover the last part of that. Boom, boom, boom. All right, yeah. Okay, so finish off where we left off last time. We talked about life insurance, whole life policies. The last thing we want to look at, Sebastian, is this. There's two types of combination policies. What you want to write down is joint life. Joint life is going to be your first to die. So generally what happens is two or more lives come together and they say, hey, listen, we want to get a policy that when one of us passes, it pays out to the first person to live. This is more cost effective versus getting individual policies because it actually based the premium on base of both of the insureds. So it takes like an average of their age to come up with the premium. So when you write joint life, write first to die. And the only other part you really need to know about that is that the premium is based on a joint average age. That's pretty much all you need to know about joint life. The second part of that is going to be called survivorship life, which is called second to die. Almost the exact same concept, except that the way it pays out is that it pays based off of the last survivor. So, if you have one person, it's not going to pay out. It's going to pay out on the second person or the second or third person to die in the policy. Generally, you would get this policy not for your spouse, but maybe your children or grandchildren. That makes sense? Okay. All right, so the next big thing we're going to cover is annuities. All right, so what you want to write down right here is this, Sebastian. An annuity is a contract that provides income for a specified period of years or a life. So an annuity is not a investment vehicle per se. It is a investment option, but it is sold from an insurance company. Oh, excuse my nose at you. It comes from an insurance company. So the things we want to look at is an annuity is meant to help liquidate an estate. Um, Actually, so you should write this right here. An annuity provides individuals against outliving their money. So what does that mean? So when you lock your money into an annuity, you're giving the money to the insurance company for a long time. And when you start to receive money from an annuity, you will actually not be able to take the money out in a lump sum once you've chosen to receive payments because the money is now the insurance company's and they're going to pay you a monthly benefit based off of the option that you choose. Okay. So the thing we want to look at, so like in a policy, when you own a policy, there's a policy owner. Same thing with the annuity. The owner of the annuity has all the rights. So they can change the beneficiaries. They can cancel the annuity at any time. They can do anything for this on this investment vehicle, right? So the thing that you have to look at is based off of this annuity, what are my options? What do I have? So there is something called the annuitant. The annuitant is the person who receives the benefits from the annuity. So I'll give you an example. So if your parents just said, "Hey, we're going to open up an annuity for Roosevelt and yourself, right? They're going to be the annuity owner. You and Roosevelt are the annuitant because it's going to go based off of your life expectancy. So based off of your life expectancy is what they're going to put this into account. Now, you will be the one receiving the benefits, but you can't change anything because you're not the annuity owner. Now, this right here, you must write this down. The annuitant must be a natural person because they're taken into the account of the lifespan of the adult, or I'm sorry, of the person who's going to benefit from this annuity. It must be an actual person because they're taking life expectancy into place. Um, so the beneficiary, this is the person that would receive the annuity assets if this person, if the annuity owner or annuitant passed away prior to the balance getting paid out. Let me know when you have that, Sebastian, because that's an important thing. Okay. All right. So let's talk about this. There is something called we're going to talk about how do you pay into an annuity versus how you receive the money. When you pay into an annuity, that is called the accumulation period. When you are receiving money, I'm sorry, the accumulation period is also known as the pay-in period. Those words mean the exact same thing. You just need to know that you're going to see them intertwined with each other. Okay. So when you're paying into the accumulation period, your money's accumulating over the years, right? And when you want to receive the money, so this is called the payout period. This is called the annuity period. So right here, you want to write all this out right here. Everything that's highlighted, you want to write out. So the way an annuity period works, it has other names such as the annuitization period, the liquidation period, the payout period. This is the time in which you will start to receive the money that is converted into income payments to the annuitant. Let me know when you have that written out. Perfect. So the thing about an annuity is it's meant for someone who has money put away that doesn't want to outlive their money, but a person can't put all their money into an annuity because there's suitability requirements. So if a person has like 300 grand, you can only put so much of that 300 grand into the annuity. They have to have some money accessible, which would be called liquid money. You need to be able to have access to it because once you lock this money up, there are surrender charges and surrender fees if you try to get money out of it. Okay. Am I good to move on or are you still writing? All right. So let's talk about the frequency that you pay into the annuity. Okay. This right here is how often or how do you put money into the account. So the annuity is going to be based off of how fast you put the money in, how soon you want to get the money out. Um, so let's kind of go through a couple options of how an annuity can be purchased. Annuity can be purchased for most of the part for retirement, college education, structured settlements, liquidating a premium sum. Like your parents can set up an annuity for their retirement account right now. They can set up a college fund for Roosevelt right now. A structured settlement. Let's just say you get into an accident and you get a big check, or if you win the lottery, you could put it into an annuity where they'll pay you monthly. Actually, the lottery is an annuity. Um, if you don't take the big payout. Okay, so this right here is where we're going to talk about the frequency of how you pay into it. This is what you want to write down. The two options of paying into a policy or to um, an annuity is single premium. Under the word single premium, I want you to write the word lump sum. Lump sum, meaning you pay a big one check up front, you deposit a lot of money, and you just let that thing ride out. Okay. So the next one is going to be this one, periodic payments. Next to the word periodic payments, obviously, common sense, it's payments over time. Now, Sebastian, you could pay into this annuity either level premium, so you just pay the same thing over and over again, or flexible premium, which you just pay a little bit here, a little bit there. You have the option to do that. So you want to make sure you write that out, Jade. Periodic payments, you can have it in leveled or flexible premiums. Okay. Next thing we're going to talk about is immediate versus deferred annuities. So this right here is talking about how soon can you touch the money. So what you're going to write is immediate annuity is less than a year. Immediate annuity, less than a year. And deferred annuity is going to be later than a year, after a year.
I ask you something. Yeah.
Okay.
Why do nice?
Okay. Okay. So now the next thing we're going to cover. You still writing, Sebastian? All right. All right, Jade. So this is the thing we're going to write. So fixed annuities are just like this. You're going to write all of this out right here. Give me a second. Hold on. I might have a cheaper, or I'm sorry, faster way. Okay. You're going to do it right here. You're going to write out this entire bar right here. So write out like a T bar. So the way you would do it is fixed annuities and variable annuities are completely separate. They're completely opposite. Hear that, baby Jade? Come here, puppy. You want to talk about annuities with me? Come on. You talk about annuities with daddy. Tell YouTube, hey. Hi, YouTube. Okay. So fixed annuities and variable annuities are completely opposite of each other. So fixed annuities are going to be suitable for your elderly people, okay? Variable annuities are going to be more suited for your people who can afford to take risk. All right. You see mommy? Hi, mommy. Hi, mommy. Oh, he's waving. Okay. So if you look at this in this chart right here, the underlying investment, what does that mean? You see where it says general account, safe and conservative? That is because the insurance company is going to keep your money and their money combined in the same funds. But if you look at variable annuity, they say separate account. They say because you are you're going to do a variable risk because you're taking on the risk. We're going to separate our money. We're going to put your money into a separate account. There's no guaranteed interest rate. Whatever the market does is what it does. You get the benefits or you reap the losses if there are some. Okay, so this is the licenses that are needed. In order to sell a fixed annuity, all you need is your life license. That's all you need. For your for your variable annuities, you need your life plus securities. That is going to be your investment license. Okay. One thing that's guaranteed, expenses. There's always expenses. There's always fees in these annuities. That's how you get paid. And then income payments, they're guaranteed to come from a fixed annuity because the money's growing at a guaranteed rate. You're guaranteed to have that money there. But for variable, you don't know what's going to happen with that account. Get your fingers out your mouth. Get your fingers out your mouth. Until you're older, that's what you do. Until you know, that's right. You know what I'm talking about? That's how you got here. Right, Sebastian? Right? Come on. Um, so fixed and variable annuities. That's all you need to know about the differences between them two. But let's talk about where does a fixed annuity come into place? If you sit down with an older person and they say, hey, listen, I have money. I want to get more, I want to get a better rate of return than what I'm getting at the bank, put into a fixed annuity. They're going to get better rate of returns, but without the risk. If you're sitting down with a young person like yourself, Sebastian, hey, I got a few hundred grand. I want this thing to grow over time. Put that into a variable annuity, let that thing ride out. You see the camera switching over to the baby? I don't know if you can see that. That's hilarious. Um, you see, brother? Um, okay. All right. So that's all we're going to cover about annuities right now. Okay. We're going to cover more about the settlement options of how they get paid out in chapter 3. Kid, hey, get, hey, go sleep, go sleep, go sleep. Um, yeah. All right, cool. You want to take a quiz, Sebastian? You want to see how we do? Let's see how we do. Let's take a quiz. Um, all right, so chapter 2. All right, the main difference between immediate and deferred annuity is what?
All I have is the different uh years off that. Is the immediate is less than a year and the deferred is more than a year.
So then look at the answers.
Daddy,
I just came into the room, sure.
mommy, mommy,
Oh, 1 year.
mommy.
See?
Will it be D?
Yep, it would be D.
Okay.
Just like you like it. The main difference between immediate annuities and deferred annuities is when the income payments begin. So immediate annuities will begin payments within a year. Deferred annuities will begin will not begin payments until after the first year. See, all I did was give you the beginning. All I did was give you the definition.
Yeah.
That's all you needed. I don't want you to overthink this stuff.
No, 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 no.
All right, which of the following life insurance policies allows a policy owner to take out a loan?
All right, I gotta
So
go through all these notes.
go back to the beginning. Term insurance. Term insurance. There's 3 term insurance and there's 1 universal life. Universal is a whole life. Everything else is term. So go back to the skeletons of whole life versus term.
Take out a loan. Read this. Handwriting is the best.
Dámelo. Dámelo. No, we don't do that. We're Chinese. I swear. All right. What are we thinking, guys? Jade, I think you said D. I think you're muted, but I think you said D. Unless you just said tell me what she was craving. You're muted, Jade. What did you say, Jade? I can't hear you. You're muted.
Are you guys not in the same room?
No, no. She's
Oh,
upstairs.
okay.
She's downstairs, but I can still hear her. No, but what are you going with, Sebastian?
Uh,
My daddy, I do, my daddy, I do, my mommy, you,
All right, Jade, you think it's D?
my dad, you, my do.
you know, yeah,
Is it
I also go with D.
Why do you go with D though?
I don't know.
Besides your pink shirt.
Oh, policy one. Yeah, I go with D.
Besides your pink shirt, why?
Because I have here written in my notes that in universal life it can borrow cash value, and policy loans means you can borrow cash value.
Correct. You could borrow from the cash value. Remember
Yeah.
this, all term insurance has no cash value. So if you need to go back to your term notes and write no cash value in big bold print, do that. But yeah, good job. That's right. Okay. The policy owner of a universal life may skip paying the premium and the policy will not lapse as long as. So go back to your notes for universal life and you're going to look up what is called the target premium.
Is recommended amount that should be paid on a policy in order to cover the cost of insurance.
Yeah. So what happens in this situation, I'm just going to explain this to you. Universal Life has 2 options. You have the minimum payment and the target premium. They recommend you put the target premium because it will allow the cash value to grow. So if they want to skip a payment, they've overpaid into the policy.
Mhm.
So kid. So it started to grow some cash value already. So just based off of that knowledge, what does that say? Off of that knowledge, what do you guys go with?
Miguel? Just send him downstairs. I'll put something on the TV.
No, I'm fine. I'm fine with him. He's
No, not baby
said
shark.
me and my daddy hanging out.
Daddy,
Say me and my daddy.
Daddy, baby shark.
You want to watch Baby Shark?
Yeah.
Okay. Of course, Baby Shark's downstairs.
No.
Come on. What do you think this one is?
No. I want to say,
Go with your gut. Go with your gut.
I feel like my gut's wrong.
Okay. Well, what is it?
I was gonna say B. I was gonna say B.
The previous premiums were high enough to create an excess of premium.
Yeah, it even sounds wrong.
Yes, but no. The next month's premium is sufficient to cover both the current month and the skip premium. The policy owner cannot skip premium without the policy lapsing. And the policy contains sufficient cash value to cover the cost of insurance.
Or maybe D?
What is it?
D?
No, it's A.
Oh, it's A. Okay.
Okay, so Jade said A. So in universal life, the policy owner may skip premium payment. Make sure we're taking notes here. Without lapsing coverage, as long as there's sufficient cash value sitting in the policy.
All right. I got it.
Okay. Let's move on to the next one. All right. A life insurance policy that only requires a payment of premium as an inception provides insurance protection for the life of the insured and matures at 100. So you're making,
Uh,
go ahead.
Single premium whole life?
Good job, Sebastian. That's right. There you go. You guys are getting it. You guys are getting this. Okay. Fixed annuities provide all of the following except. So fixed annuities. Hi, baby. Yep. So remember, fixed annuities are complete opposite of variable annuities. And when you read all the following are except, you're looking for the wrong answer. So, hey, stop touching the internet. That's my mom. That's your mommy. And that's your daddy. And that's your mommy. And mommy. And daddy. Yeah. So fixed annuities. Go back to your fixed annuities bar. If you look at those notes, which ones can we let's use the process of elimination. What can we get rid of?
Uh, Minimum guarantee?
No, the minimum guarantee. Yeah, get rid of. Yes.
Yeah, yeah, yeah.
Yeah, yes, you can get rid of that one.
And then I was gonna say the answer was the equal monthly payments.
No, because it's fixed. Fixed is guaranteed. It's gonna be the same thing.
Oh, I'm sorry. I'm reading variable. You're right.
Jade is saying C. So listen, that
Yeah,
is
yeah, yeah.
answer is C. So I want you in your T bar. I want you to write something again. Write fixed annuities do not keep up with inflation.
Okay.
Fixed annuities do not keep up with inflation because the interest rate is too low that they're going to give you that it will not keep up. Does that make sense?
Yeah.
All right, so let's move on to the next one. All right, which of the following is incorrect regarding a $100,000 20-year term policy? So incorrect. What are we looking for that's wrong? Oh, I already see it. A 20-year term policy, guys.
Mm, D.
No. Is incorrect. What do we know about term insurance? If the family passes away in between, if the person passes away in between that 20 years, the family's getting the money. The premium, it says a 20-year level premium, so we know the premium's going to stay the same.
Yeah. And the policy will expire. So it's A.
Okay, why is it A though?
Because after the 20, because the family gets the money if he dies within those 20 years. But if he survived it, then there's no
Read
point of the 100.
read A.
At the end of the 20 years, the policy's cash value will equal 100,000.
Okay. Does term insurance have cash value?
Oh, no, it doesn't. You're right. You just said that.
So you see how the questions are starting to repeat themselves?
Yeah.
It's a concept we got to know. Term insurance, no cash value. Everything else about term insurance is true here. It will expire after 20 years. The policy remains the same for 20 years. And if the insured dies before the policy expires, the beneficiary will receive $100,000. So term insurance does not develop cash value. All statements are true. All right. An insured purchased a 10-year term policy that is guaranteed, renewable, and convertible. What happens at the end of the 10 years? So it already gave us what we need to look for. So if we go back to our notes about renewable and convertible term, then we can make this thing an open book test. All right. The first answer is the insured may renew the policy for 10 years, but at a higher premium. The insured must provide evidence of insurability to renew it. The insured may renew the policy for another 10 years at the same rate, or the insured may only convert to another term.
Would we be able to eliminate B and D, or would that be one of the answers?
Okay, no, which ones you want to eliminate? Let's go there. Let's
B
go
and
there.
D.
Yes, we can eliminate those two. And let me kind of expand on D. The insured can only convert to another term. If you convert to a 10-year term, you have to convert to whole life. You can't go from term to term.
Okay.
In the convertible option, you can renew with another term policy, but you can't convert. But yeah, we got rid of B and D. So the answer of A and C is if you renew the policy, is your premium going to stay the same or is it going to go up based off of your new age?
It'll go up.
Yes,
So it'll be A.
it'd be A. Good job. Good job. All right. All right. So okay. Which of the following types of policy allows for flexible premium and a variable investment component? Well, let's go through all the whole life policies. The only one, let's go with the ones that say the word variable in the word whole life. Because if it's already saying variable, okay, we know it's a variable whole life. So what are we thinking, guys? All right, so Jade, we left off at which of the following policies allows flexible premium and variable investment components? The only type of policy this could be is variable life or variable universal life.
Wait, repeat what you just said. I'm sorry.
I am the greatest thing in the world since sliced bread, since the greatest flan ever made. Um, no, what I said is, and it says which of the policy allows flexible premium and variable investment components. I'm just going to give you all the answer. It's variable universal life. So let me give you why it's the answer. Variable universal life policy components combines flexible premium and investment components of variable life. So in universal life insurance, it's flexible premium. And all you did was add the investment component of a variable life. So the very account that can fluctuate highly based off of the investment.
Yeah, I was staring at my universal life definition for the longest. I just didn't say it. I don't know why. I thought it was the right answer. I just didn't want to. I don't know. I guess doubt myself.
Stop doubting yourself. You're too great to do that. All right. The term fixed in a fixed annuity refers to all the following except fixed annuity. All right. What do we think, guys? All the following except.
Is it D?
Okay. Okay. I see what's on your mind. Chill out.
Huh? Miguel.
Just me and Jade.
All right. Let's go with D and see what it says. See, Jade, it's on your mind and you got it right. But no, let's talk about why is it right. So the death benefit from an annuity is the career portion. That's what it's asking. The death benefit in annuity is not life insurance. It's whatever the money's left over if you get anything at all. All the word fixed was saying, hey, fixed annuities have equal payments, guaranteed interest rates, and the length of time is it's all everything is fixed. It's locked in. It says annuities do not provide death benefits. So if you knew that, boom. All right, next question. Which of the following, which annuitant, the annuitant dies while the annuity is still in the accumulation stage? Which of the following is true? So we didn't talk about this, but this is a good one for us to go. I want you to just think common sense when you read this. So now the money, it was going to go to the annuitant, and now the someone else is going to go to the beneficiary.
Hmm.
What are we thinking, guys?
I was gonna say either A or D because I believe it goes to the beneficiary no matter what.
Yes, yes.
Will it grow tax deferred? I want to say D, but I f- my mind is telling me D.
Okay, good.
Say D.
Your mind is telling you one thing, but your body's telling my mind, my body.
Miguel, what is your deal?
No, we can't even see if it's right.
It is the answer. I skipped it on accident, but
Oh,
that is
okay.
it is. All right. An insured buys a 5-year level term policy with a face amount of 10,000. The policy owner contains renewable and convertible options. When the insured renews the policy in 5 years, what will happen to the premium?
D. Right.
Do you go with that one, Jade? Is that what you go with?
Oh.
No. Is that the one you go with? Let's actually answer the question. Let's not skip through this.
Okay.
All right, an insured buys a 5-year term policy. The face amount is 10,000. The the policy contains a renewable and convertible option, so they can renew it or convert it to whole life. When the insured renews the policy 5 years later, what will happen to the premium?
Will increase.
Why?
Um, don't let our door, Miguel.
Do you right? Why?
Uh, because
Jade, don't worry about the door. Worry about the question. We're talking about convertible options. Why? Why is it D?
because the person will be 5 years older.
Bam.
There you go, man.
Only the question I was looking, answer I was looking for. Great job. Great job. All of the following are true about variable products except I want you to go back to your T-bar. The difference between variable and fixed. You're going to see the answer right then in front of your face.
Not guaranteed.
What's not guaranteed?
Cash value.
All of the following are true except. So let's go with the process of elimination. We're talking about a variable product. The minimum death benefit is guaranteed. There's always a minimum death benefit.
Wait, wait. Is it B?
Okay, you want to go?
Because they get it in separate accounts and not and fixed is general account, right?
What do you think, Jade?
You said D?
Is that what you
B,
want to?
B?
You want to go with B or you want to go with D?
please.
Jade, which one do you
Sorry.
want to?
I'm really having a really slow moment right now. All of joke.
It's okay. That's how I felt at the start of it.
All right, the following products are true about a variable product, Jade.
Yeah, I'm listening. Is it B?
Is that you want to go with B or D?
I mean, there's no guarantee with the variable with investments, and then there's no guarantee. I can't even read my own handwriting. I don't know.
Sebastian, great job. They put it into a
Good job.
Thank you.
okay. All right. Under which of the following annuities options does the annuitant select the time period for the benefits? The insurer determines how much each payment will be. See the fall annuity payments, annuity options, in which this is the part that I kind of skipped over because I'm going to cover a lot of this in chapter 3. But we can just use common, kind of think our way through this one. Which of the
B.
following annuity options does the annuitant select time period for the benefits if the insurer determines how much each payment will be?
Is it either B or C or what? Or it's either B or C. Okay.
Keep
Installments for a fixed period.
yes, absolutely. It's a
Yeah, I
time
was thinking
period.
because time period. Yeah.
If you
Is it
see
B?
See.
Oh,
if
sorry.
it
It
listen,
was a lag. There's a lag for a second. Sorry.
Sebastian,
Yeah.
if it says time, it's fixed.
Period.
If
Yeah.
it says fixed dollar, like fixed payment, it's the fixed amount.
Okay. Gotcha.
Okay.
She's using context clues.
Which of the following best defines target premium of universal life? So go back to universal life in your notes.
Is is option A and B mixed in with target premium or no?
No, that's the death benefit.
Okay, gotcha. Amount that should be paid on the policy in order to cover the cost. Oh, wait, no. Or maybe. Okay, so it's not A
Okay,
because corridor is death benefit, including with option A and B.
correct.
Is it C?
The minimum amount to keep the policy. No, that would be the minimum payment.
I'm going
So
with
it's
D.
D?
D, like
I'll go with D. Okay.
derogatory.
So listen, the answer is D, but this right here is the definition of D. So if you don't have this written out, write this out.
Okay, cool. I'm very sure. Perfect.
Target premium is the recommended amount should the
That should
policy,
be paid.
in order to cover the cost of insurance, to keep the policy in force over time.
Where are we going?
Oh, you guys got that written out? You understand that? Jade, make sure we have this written out. That's important. But do you start to see that even all throughout the notes we took, the more we go through these questions and we say, okay, oh, that's what that means. This is how these connect.
Yeah.
The more we do this, and it has to be a daily thing of studying consistently, because as I give you the cliff notes, it'll all
There
make
you
babe, you good?
go.
Huh?
Are you good to move on or no?
He was there 2 days ago as well. I don't know why he's
Give
not
me a
there.
second.
Hey Siri, give me a second.
Miguel.
Yeah. He was doing good. I don't know why he wouldn't show up today.
Good, babe?
Yes, Gabriel, get over, or Joel, get over
Guys, I
here.
think we're at the last question. Okay. If a contract provides a set amount of income for two or more people, with the income stopping at the first death, that is going to be joint life.
Point life. Yeah. See? Got it.
We didn't go over that, but it's called joint life. Write that out.
That was the first thing we went on.
No, we went over joint. We went over joint and survivor life. This is annuities. So
Yeah, I've got joint life first to die, joint average age for premium.
that's for life insurance. That wasn't annuities.
Ah.
These definitions kind of intertwine. They sound the same.
Oh, okay.
That's why I want to take our time on this chapter, because it can be
Gotcha.
very all right. So let's see. How do we do? Got 100. We got 100, y'all. Look at
Big,
y'all.
big hundo. Big hundo.
See, good job. Good job. Very straightforward, very